your social security number, your driver's license, neither of which were invented to facilitate transactional identity. Why don't we have a better system for transactions?
Hey everyone, I'm Pat Kinsel, founder and CEO of Proof, and welcome to the first episode of The Payment Parallel. I'm really excited to be joined today by David Stearns, who wrote an incredible book. If you've had the chance to spend time with me lately, I've probably pitched that you go out and buy it. And his book is actually the basis of a podcast that's gotten a ton of acclaim, acquired, and it's about the future of, or history of Visa and the payment networks. And so, David, I'm really excited to have you with me here today and to introduce this podcast series.
Well, thanks for having me.
So, everyone knows that I've run an online notary business for years that's transitioned more recently into being about transactional security. And I read your book, I listened to the podcast, and I do what I do so often, which is I just randomly reach out to people and I try to start a conversation. And so I reached out to you, and I'm just curious if you can help explain to everyone when they go search for your book. It's called Electronic Value Exchange. Why is it so expensive?
Yeah, well, unfortunately, it's the realities of academic publishing that make it so expensive. So that book was actually my PhD dissertation. I did my PhD in the UK at the University of Edinburgh, and in that model, you have an external examiner who basically decides whether you pass or fail. That external examiner was doing a new series with Springer on the history of computing, and he asked if I would be interested in including or publishing my dissertation in that series. And I thought, great, this is fantastic. But Springer is an academic publisher, which means that they put the content into an electronic offering that you can get at any university library pretty much for free. But they only print a few hard copies for depository libraries, and they price those hard copies accordingly because it's such a small print run. And I think they've been confused as to why I keep selling hard copies of this book when most academic books don't sell any hard copies and only do the electronics.
Well, I'm doing my best to sell them at $130 a copy or whatever,
Yeah,
whatever
so
it may be.
apologies for the expense of that. But if you do have access to an academic library, you can also just go to the academic library and probably download it as a PDF.
For sure. And so one of the things I really love about the book that you wrote is it's a very multifaceted, examination of the history of payments, right? And you in your career, you were an academic, you wrote this book, but you've also been a practitioner, right? And so maybe before we get into the book and some of what we want to talk about, you could share with folks what you've been doing for the last 20 years of your life after writing that book.
Yeah, actually, I started out as a software engineer. So I spent the first 9 years of my career at Microsoft, and I was a software engineer and then a program manager. Shortly before I left Microsoft, there was this ad for a talk by a architect from Visa that Microsoft had hired away. And so I went and said, okay, this is interesting. And that's how I first sort of heard a little bit about what Visa is and how the systems work. And I thought it was very fascinating because it's that kind of a system you use every day and you never think about it at all, which is kind of an accomplishment when you think about it, right? When I flip on my light switch, the lights just come on. I don't have to care. I don't have to know how that happens. I open my water tap and water comes out. I don't really know how that occurred, nor do I have to care. And I can just go to a shop and use my Visa card and make a purchase anywhere in the developed world, and it just works and I don't have to care. And as a software engineer, I find that to be an amazing accomplishment. It's kind of what we refer to as technological infrastructure. It's just there, things are built upon it, and people can rely on it every day. Then I went and I did the academic thing and the grad school PhD route. And when it came time to think of a dissertation topic, I came back to that. I thought, that would be really fascinating. I wonder if anybody's written on this. Turns out that actually very, very few things had been written on the history of Visa, which is why I ended up looking at that. I did teach for about 5 years at the University of Washington, but then decided to get back into the software industry and have I worked for Adobe for a short period, and then somebody from Stripe randomly reached out and asked if I would like to come and talk. And that led to some discussions and led to eventually me joining Stripe as an engineer. And I worked at Stripe for about a little over 4 years.
So it's pretty amazing because you've looked at the history of the payments industry and then you've been at Stripe trying to move that whole category forward, a company that's credited with a ton of innovation. And to me, I agree with what you said, as a system that sort of works in the background. I love a systems engineering challenge. I love thinking about the combination of policy and product and, the whole, people in the loop and behavior and whatnot. And I think that your book and the history of Visa really touches on all of those things, but also change management, right? So for me, I often say that as a company, Proof and formerly as Notarize, it's not just been about getting the rules changed; it's then getting companies to adopt and to agree, and it's interconnected, right? So you sign something, you send it to someone else, and so maybe if you could, for folks listening, and they can go listen to that longer podcast that was done, and they can buy your book, but sort of a short summary on where was the world pre-Visa, and maybe like what were the main chapters of the story that it took to get that system to work and drive that change.
Sure. So Visa as a system, usually people will date it back to the Bank America card and its launch in 1958, which was a private card of the Bank of America, very regional. It was only in California, but eventually this grew and became an independent system, and then many, many banks joined in, and now it's a worldwide thing. Prior though to bank issued credit cards, there were two primary non-cash ways that people would use to make payments. And I'm going to focus on the United States. This history is similar in other parts of the world, but with its own sort of wrinkles. But the United States history is kind of where I've rooted because that's where these bank issued credit cards really came out of, and how the Visa system arose is really out of the United States. So prior to bank issued cards, there were a few other options. One is that cards had existed actually for the entire 20th century, um, but they were usually issued by the retailers themselves. And so it was like if you wanted to buy things at Sears, you had a Sears card. If you wanted to buy things at a different sort of retailer, you would have a card that was specific to them, and your account would be with them. If you didn't want to use store issued cards, or you couldn't get a store issued card, your other option, if you had a bank account, was to use paper checks. And many of us who are old enough remember writing paper checks all the time. They are still in use, but their usage is declining rather rapidly. And those paper checks were useful in very trusted situations because a paper check is not a guaranteed form of payment. It is kind of just an instruction that says, I would like the bearer of this check to receive the money, the amount of money that's specified on the front of the check, but the bearer actually has no guarantee that that money will be available when they deposit that check. So it was something a merchant might accept, and they usually would accept, but they would do it cautiously. And so when you think about a small town where maybe the merchant knew all their customers, it was much easier face to face, a little bit of analog facial recognition. They could say, yeah, I know Pat. I trust Pat. Pat comes in here all the time. If Pat writes me a bad check, I'll probably be able to collect from Pat later when he comes back in. But if you're in a larger urban center, you don't know these people. And as a result, when they come in, you're probably going to be quite suspicious, and you're going to look for other signals of trust. Some of those might have been, show me your driver's license. And I'm going to verify that the name on the check matches the name on this driver's license. And oh, this teeny little outdated picture of you. I'm going to try to make sure that that's still you. And maybe it is, maybe it isn't. It's hard to tell. And then I'm probably going to write down your driver's license number and use that as sort of an identifier so that if you do bounce the check, I'm going to be able to at least recognize you when you come back into that store. But of course, merchants weren't yet sharing this information with each other. So if you were writing bad checks at one store and they caught you over there, you could still go and probably write bad checks at another store, and there would be no particular information sharing going on. This is before we had these kind of check guarantee systems, which they don't come until about the same time that bank issued credit cards come in. But bank issued credit cards, these were the things that were an innovation in the late 50s is when you start to see most of these bank issued card programs launch is throughout the 1950s. And then 1958 is when the Bank America card program launches. This one is one of the only ones that is actually successful at scale and becomes licensed to other banks starting in 1966. So at this time, this is also one of these things where people who are a little bit younger may be surprised to learn that banks used to be constrained to a geographic region which they could operate.
I was blown away when I read that in the book. I mean, I had heard that, but thinking about the implications, I think that's a very important part of the story.
Yeah, so one of the things is when when the founders of this country decided that they were going to structure a banking system, they purposely fractured it. They purposely made the banking system much more fractured than it was, say, back in England, for the purpose of making the banks have less power, so they could not amass the kind of power the Bank of England had. as a result, they created these very sort of draconian rules that said banks couldn't operate across state lines. And within many states, banks were also very restricted even to a single location. So a bank would be able to have one branch, and that was it. They couldn't have multiple branches even within the same state. California was one of the few states that did allow banks to operate across the entire state. California is obviously a very large geographic state, and it was also a very wealthy and populous state in the 50s. And so Bank of America was actually one of the largest banks in the world when it launched this card. They had a tremendous amount of resources to absorb the initial losses that just came with launching a new kind of program like this. Um, and they also had to scale to get the thing off the ground because they had a relationship with about a little over half the households in California at the time. They had a relationship with many, many, many merchants because they had given them their initial business loans. They did their banking for them. As a result, it was easier for the Bank of America to get this program off the ground because it had this relationship with both sides of the system, both actors, both sides of the market that needed to kind of be brought up at the same time in order for the system to get kickstarted.
There's so much in what you're sharing there, and I wish we had 5 hours. I mean, I just think the confluence of events and circumstance, the fact everyone at some point who works in fintech learns that Bank of America was the Bank of Italy, and oh my God, but also, everything is shared about it being in California, California allowing a bank to operate across the entire scope of the state. I mean, it's just so much put them in a position to be such an innovator in the market. And maybe, to kind of jump down the path of the narrative a little bit, or the history. So a lot of what was required was getting people to agree, right? And so I think people listening can piece together that the model that you're talking about kind of wouldn't work because people weren't sharing information and whatnot. But what were sort of the key innovations or insights or data points or strategy that finally got them to be able to build a network and solve some of the problem?
Yeah. Many of the banks at this time, especially the big New York banks, really did want to build a system all by themselves. And in many ways, the Bank of America system was initially Bank of America's baby, and they did license it out, but they kind of retained all the control initially. So it was always this tension of the largest banks really did want to build their own system, control it, run it all by themselves. But they kind of they couldn't pull that off at even a nationwide scale, and certainly they could never pull it off at a worldwide scale. So to compress the story quite a lot, the Bank of America had licensed the card out to many of these banks, but the system wasn't working very well for various sort of organizational and systemic reasons. One of the licensee banks was up here in Seattle, and where I'm from, and the program was being run by a guy named D Hawk. And at the organizational meeting for the licensees in 1968, all the licensees were very upset with the system. They were really considering getting out, maybe launching their own programs. But this guy, D Hawk, thought, there's a bigger opportunity here if we collaborate and work together. If we work together, we can build a system far bigger than any of us could ever build alone. And we could even build a system that could be worldwide, not just nationwide. Now, this was a tough sell. It was not easy for him to do this. He talks about in his autobiography of having to set up a home office with multiple telephones and constantly on the phone for just days and days and days trying to get all of these bankers aligned to the idea that we should form a cooperative organization. The idea of a cooperative organization in banking wasn't entirely new. It was used for other kinds of structures, but it was definitely a harder sell for these card programs because I think everybody wanted to see if they could roll their own or be their own or be the only game in town. But when it comes to something as large as that, it's just very difficult for one organization to pull it off on their own. And it's so much better if everybody can work together to create a network system.
So can I ask, I think everyone listening, it's the age of AI, right? And I think our faith and our confidence in software and computer programs to make decisions and complete complex tasks is as high as it's ever been. So I think people might not appreciate how broken it was. And so, maybe in situ, like you're standing in a merchant and you've got an instance of fraud, or you suspect you did back in the day, like how broken was the system before what we all get to enjoy today?
Right. So yeah, let's rewind back to the 1960s because the electronics doesn't come in until the early 1970s. a typical card purchase through using a Bank of America card or other kinds of issued cards usually would go something like this. You would hand a card to the cashier. The cashier, there's nothing really on the card that identifies you beyond just a name and then usually a signature panel, which back then people did take a little bit more care about their signature. But as we all know, we don't sign things quite the same every single time, and our signature changes every time. But that card would have our account number on it. It would have a name. Every business would have what was called a floor limit, and this was the limit sort of under which the person on the floor, could make a decision about whether to authorize the transaction or not. And the floor limit varied by the merchant category. So merchants that had higher risks of fraud would have lower floor limits and vice versa. If the transaction was under the floor limit, the cashier could simply take your card, copy by hand the contents to a sales draft, and then eventually the cards became plastic and had embossed numbers, and they could sort of squeeze those embossed numbers against carbon sales drafts that would transfer that information automatically. But often you'd still have to put in some handwritten information, such as like the total of the transaction and the date and various things like that. If it was approved automatically under the floor limit, then the transaction was just done. They would fill out the paperwork, they'd stick it in a drawer, and then that physical piece of paper had to get deposited at the bank that the merchant used. The bottom layer of that sales draft was actually an 80-column punch card, an IBM punch card. But because, it's not punched yet, it just has sort of information transferred onto it, written onto it. Some person at that merchant bank would have to then physically punch the card according to the data that had been transferred onto the sales draft. And then that card could be tabulated and sorted as the representation of the transaction. But this would take, quite a while to accomplish. And it would also be subject to whether or not the transaction, the cardholder's bank, was the cardholder's bank the same as the merchant's bank? If so, that's good, because then the merchant bank can say, all right, cool, I know the target account for this. I can tabulate it up. I can send them their bill. But let's just take that scenario. Even if it was within the same bank, you would get your bill once a month you get the sales drafts in the mail saying, here are all the transactions that you did that month. And so at best, if it was a fraudulent transaction, you would probably see that about a month after it occurred, or, say a few weeks after it occurred. And that would be the first time you would be able to notice that anything went wrong. That's in the best case. Now, take the case where the cardholder's bank is not the same as the merchant's bank, which became more common as people started to travel more in the United States post, say, the 1950s. And especially with business travel, people are going across state lines, so they're almost guaranteed to have this scenario. Those are known as interchange transactions. And in those cases, the physical sales draft had to be physically bundled up and mailed to the other bank. The other bank would then receive them and tabulate them and put them on the customer accounts. And then the banks would decide how they were going to settle these transactions. At that time, prior to the independent organization that would become Visa, the interchange fee, the fees that the bank would charge each other, were basically just bilaterally negotiated. And it was kind of a mess. And so as a result, they would often end up having these kind of ledgers of who owes whom that never got settled, right? But these physical sales drafts being mailed to other banks, this would take quite a while. Things would get lost. Things would have to get dug out of warehouses and processed later. And some of the folks who I interviewed for the history described situations where they walked into back rooms, sorting rooms, and they would see these sales drafts just piled to the ceilings. And these were sales drafts that occurred probably months before, but they still had not been processed and tabulated and sent out to the cardholders. So at worst, we're talking about it would be months before you would see a fraudulent transaction and be able to say, hey, no, I didn't make this. This is not me. Now, this is all, of course, we've described so far in a situation where they don't have to do any authorization because the transaction's under that floor limit. If it was above, then they'd had to get authorization from the cardholder, the issuing bank. And at this time, there was no point of sale terminal that they could swipe a card through. The cards didn't have a mag stripe anyway. And so as a result, the merchant had to pick up a telephone and dial an authorization center. Actually, I should probably do it this way, since they probably were also not using touch-tone phones. They were using rotary phones, if those who remember rotary phones. They would call the authorization center and they would have to manually relay all the transaction information verbally, right? The person on the other end would flip through if it was the same bank representing the merchant and the customer cardholder, then the cardholder bank and merchant bank could look through a bunch of printed documents to see, okay, well, how many charges has this cardholder made within this particular last billing cycle, and do they still have enough transaction limit to allow for this? Okay, yes. Or has there been any kind of reported fraud on this card? Okay, now we can maybe say no, decline. Now that was a slow process for sure when the bank that represented the merchant and the cardholder was the same bank. It was very, very slow if now we had an interchange scenario and the cardholder bank was different than the merchant bank. Literally, what would happen would be the merchant's bank would have to put the merchant on hold, pick up another telephone line, and call the authorization center for the cardholder bank and relay the information again verbally, hoping that they didn't mess up the card numbers or the expirations or anything like that, and get a verbal confirmation of an authorization, then relay that back to the merchant. This is known as a two-legged call. This could take, 30 minutes, an hour, much longer, especially at places, times like hotel checkouts, when everybody's checking out in the morning. People would literally just leave their card at the desk, go have breakfast, and come back and pick it back up because it would take usually more than an hour for the hotel to work through all of the authorizations they needed to process that morning. So this is incredibly slow. Information flow did not facilitate quick discovery of fraud. And when fraud was discovered, shutting that card off was also really difficult because you could still make transactions under the floor limit without ever having to call for authorization. And the poor merchant at that, making that floor limit authorization has no idea this card has been compromised because there wasn't really much information they could go on. Now, eventually they had published bulletins, which were these booklets of card numbers that were known to have been compromised. And merchants could look through them, and they were supposed to look through them to find out whether that card number was in there. But as you can imagine, if you're a respectable person and you're making this purchase, and then all of a sudden here's this cashier looking to see if your card number is hot, it's a little insulting, and it kind of comes across badly if you're trying to, make your customer feel valued and trusted. And so a lot of times merchants simply just wouldn't look at these bulletins and roll the dice, and hopefully it didn't turn out to be fraud.
It's ludicrous. I mean, I think that, look, I imagine people listening, the first reaction is just what a fraudster's paradise, right? I mean, the ability to just go from store to store and city to city and just commit fraud rampantly is incredible. But I also think that I think people's other reaction might split into two camps. And I think some people are hearing this story and saying, no freaking way. There's no way that it actually functioned that bad because they grew up in today's world. They probably wouldn't know how to work a rotary phone. But there's also people who are still living that reality today, right? And I think that, it's funny you tell the story of walking into a back room and seeing stacks of paper. I mean, I've visited some of the largest mortgage lenders in the country and sat in the lobby, and a FedEx truck comes and drops off, 30 feet of boxes, which sit unsecured in the lobby. How's that any different, right? And I think Doge going into government buildings today is walking in. I think it was a Washington Post article a couple of years ago that showed, what the processing center for the IRS actually looked like. And it's exactly like you described, just at an infinite scale. So, I think we are at this sort of crossroads where some people are moving forward and some people are stuck, right? So I call you out of the clear blue sky and I say, hey, look, I've got this notary company and we're trying to advance into digital transaction, authorization and whatnot, and identity. And your reaction is what? That I'm nuts? Your reaction is that you see it? Like, what were you thinking?
No, actually, it was very fun because when I was studying the history of Visa, one of the things I kept running up against is, why don't we have a better system for establishing legal identity for transactions? Even in the 1960s and 70s, this was an active conversation. The United States has always sort of relied on these proxy techniques. I guess what I'm thinking of is your social security number and your driver's license, neither of which were invented per se to facilitate transactional identity, but we use them to do that because we just don't have anything better, right? I just find this to be rather fascinating. So when you called up, it actually reminded me of an experience that I had just before you contacted me. I was trying to roll over a 401k into an IRA like one does when you leave jobs. And I went to the plan administrator site and I went, okay, I want to roll this over into an IRA. And it says, okay, now you need to download this PDF and print it out. Well, okay, thank God I still have a printer because, a lot of people don't have printers anymore. And then you need to fill out the form in the presence of a notary and get this thing notarized. And then you need to mail it in to this address on the form, which I hope is like a legitimate address. And I hope that nobody intercepts this along the way. And of course, I was able to get it notarized. I didn't know about notarize.com at the time. I probably would have used that, but I instead went to my local bank. And, watching the notarization process was fascinating because, again, the notary has to look at ID and sort of look at this teeny little outdated picture. And they don't really have any equipment to validate that driver's license, like you do, say, the TSA has at the airport. They have much more sophisticated equipment to validate it. But, the notary does everything that they can do to validate that your identity is correct. But there's, and then they stamp the document with their notary stamp. Although I'm sure that there are ways that these stamps are meant to be secure and all that. I was thinking, boy, it wouldn't be hard to actually modify that stamp number post signing.
Happens
right?
all the time in paper.
I could have taken that document home and modified the stamp number. And even if I didn't, how does the plan administrator know that that stamp is actually a legitimate stamp and hasn't been modified? And how can they even look up whether or not that stamp number is still in good standing with the home state? And so as a result, I thought, wow, this is rather odd. This is kind of reminds me of paying for something with a check, a paper check in the 1960s, and how strange it is that that's still how this all works. 401ks were created in the 1970s as well, and it feels like the process for doing this stuff is much more reminiscent of the 1970s than it is the 2020s.
It's funny. I could have a whole conversation about the 1970s. It's the advent of FedEx, the laserjet printer. I mean, there's so many things about our culture that were set in the 1970s, and there's so many things where we haven't looked at sort of the core assumptions of the way we function and asked, is it just because they figured out how to print smudge-free paper, and ship it around?
Yeah, the 1970s was an amazing time, and within payments, this is also when a tremendous amount of the innovations start to happen. We talked about Bank of America coming into becoming the system known as Visa, but in the 1970s is also when the automated clearinghouse gets started, and we have things like direct deposit and electronic bill pay. All of that stems from the 1970s as well.
Yeah, it's an amazing time, and I think, as a intro to the series that we want to record together, I think this has been a great, conversation, because I think we've presented two different worlds, right? We have the horrible, inefficient, fraud-filled, paper-based processes of old, which, I think many industries are still stuck today. And we have this future, right, which is the ability to trust transactions instantly, a group of people that have agreed that fraud will be shared and pooled and data will be shared to stop these problems. And I think then the obvious question is, well, how do we get there, right? And what policy and technology changes were necessary. And, I do really encourage people to read your book, because if anyone's out there thinking about, change management across a lot of stakeholders, policy, product, go on and on, it's a really great sort of through line of an industry. Other people have done this too. I just don't know that a book really ties the whole, story together. And so I think, I'm excited over the next couple episodes and some articles that you've written to really explore, the technology, the policy, and the change management, so that we can solve this fraud problem. I mean, I'm sure it's something you're keenly aware of. I mean, it's interesting, the floor limit concept. As I sit here listening to you, it kind of reminds me about fraud is the cost of doing business, right? And I think we're at the point where that cost is getting too high, and people are being forced to deal with this. And I think the first thing people think is, I'll go buy some machine learning software or this or that. But it was really the co-op that you described, right? The participation, the alignment that solved the problem, I think, in the payments industry. So I'll give last word to you.
And I'm assuming we will get into the electronic systems, of course, that eliminated that floor limit and reduce it. But I think you're right that as the system grows, there's a bit of a game with fraud where fraud could get out of control at some points, and then it has to be brought under control. And there's the desire is to be able to grow the system while controlling the fraud. You're never going to entirely eliminate it. It's very unlikely anyway. But what you can do is to keep it mitigated, keep it controlled, and then what we'll talk about perhaps in the last episode is that ultimately we want to make sure that the system remains safe. That even when fraud occurs, that people are made whole, people are kept safe from the effects of those frauds, which is something that exists in the payment world, and we can talk more about that in detail.
Well, I'm looking forward to it, and thanks for joining me today. And for folks, stay tuned, and we'll talk to you again soon.
Thanks for having me.